There is billions of dollars being wiped off crypto markets right now, and most Australians watching their portfolios bleed have no idea why. They just see red numbers and panic. But panic is not a strategy. Understanding is. And in the next few minutes, I am going to break down exactly why crypto is crashing, what is actually driving it, and what it means for your money right now. Let us start with the truth nobody wants to say out loud. Crypto does not crash randomly. It crashes for reasons. And right now, there are 4 of them hitting at the same time. The first one is interest rates and the global money environment. When interest rates are high, risky assets get punished. Full stop. Crypto sits at the extreme end of the risk spectrum. When central banks tighten, investors pull money out of speculative assets and park it somewhere safer. We have seen this pattern play out in 2022, and we are seeing versions of it again now. The US Federal Reserve and the Reserve Bank of Australia have both kept rates higher for longer than most people expected. That kills appetite for risk. And crypto, no matter how much its believers hate hearing it, is still treated as a risk asset by the institutions moving the big money. The second driver is liquidity. When money gets expensive to borrow, leverage dries up. A massive portion of crypto's bull runs are fueled by borrowed money. Traders taking out loans to buy Bitcoin, protocols offering yield that only works when prices keep climbing, leverage stacked on leverage. When the tide turns, those positions get liquidated fast. Forced selling begets more selling. And suddenly, a 10% dip becomes a 30% crash before most retail investors even wake up to check their phones. The third reason is regulation and macro uncertainty. Governments around the world are still figuring out what to do with crypto. In Australia, the regulatory framework is still being shaped. Globally, enforcement actions, exchange collapses, and policy announcements still send shockwaves through the market. Every time a major jurisdiction signals tighter controls or a large platform runs into legal trouble, confidence takes a hit. And confidence is the only thing holding up an asset class that produces no earnings, no dividends, and no rent. The fourth driver, and this one matters most for Australians, is the US dollar. Crypto is priced in US dollars. When the greenback strengthens, which it tends to do when global uncertainty spikes, crypto prices fall in dollar terms even before any selling happens. For Australian investors, a strong US dollar combined with a weaker Australian dollar means your losses look even worse when you convert back to Australian dollars. A 20% drop in Bitcoin priced in US dollars can translate to a 25 or 26% hit in your Australian dollar terms, depending on the exchange rate at the time. Now, here is what most people get wrong in a crash. They treat it like a verdict, like the market crashing means crypto is finished, dead, over. But crashes are not verdicts. They are cycles. Bitcoin has lost more than 80% of its value multiple times in its history, and still recovered to set new all-time highs. That does not mean it will keep doing that forever. But it does mean that a crash alone tells you nothing about where things go next. What it does tell you is something important about your own position. Because the real question right now is not, why is crypto crashing? The real question is, what does this crash reveal about your strategy? If you are watching your portfolio drop and feeling sick, that is not a crypto problem. That is a position sizing problem. The rule most serious investors use is simple. Never put more into crypto than you could watch go to zero without it changing your life. For most Australians, that means crypto should be a small slice of a broader portfolio, not the whole game. If you have high interest debt, an underfunded emergency account, or no super strategy in place, and you are holding significant crypto, the crash is telling you something important. Get your foundation right first. Shares, super, property, emergency fund. Build that base. Then crypto can sit at the edge of your portfolio as a high-risk, high-reward position without threatening everything underneath it. And if you are thinking about buying the dip, understand what you are actually doing. You are speculating on a volatile, sentiment-driven asset in a difficult macro environment. That is not necessarily wrong. But go in with your eyes open, a clear position size, and a time horizon of years, not weeks. The Australians who come out of crypto crashes in a better position than they went in are not the ones who predicted the bottom perfectly. They are the ones who had a plan before the crash started, did not panic sell at the worst moment, and kept their crypto exposure proportional to everything else they were building. So here is what you do today. Check your total portfolio. Work out what percentage is sitting in crypto. Ask yourself honestly whether that number matches your actual risk tolerance. And if it does not, the crash has just done you a favor by showing you that before it was too late. If this gave you some clarity in a confusing market, hit the like button, subscribe if you are not already, and turn on notifications so you catch the next one. I will see you there.